Hi, Michelle. Thanks for coming.
Thank you for having me.
Sure. Well, let me make a quick introduction. Got Michelle here. She's one of the top 1%, as I say, in the mortgage industry. So I personally actually used Michelle for my own property, and she worked out so well and actually was so smooth, I didn't even realize that I just got a new mortgage.
Thank you.
So I'm going to hand it over to you. So please introduce yourself and we'll go from there.
Yeah, I remember our first call. And you were basically like, I have my own property and I do business and I'm looking for a new mortgage broker and I'm going to use my own mortgage here as an opportunity to vet someone new. So that was cool. It's that try before you buy kind of concept. So I liked your style. Yeah, I've been in mortgages for, I guess we're going on 8 years now. So it's been a little bit of time and I've been having a lot of fun. My company is Cognitive Capital. We really try to make mortgages seamless. We try to educate clients along the way as well. And I'm glad that you got a front row seat to be able to see that.
Awesome. Well, thanks for coming. So as you know, there's a whole bunch of, new mortgage rules and new rates that are coming in. People have so many questions. So this episode is basically just focusing on 5 main items that I see that people have questions about. Mm-hmm. So we can start with the recent Bank of Canada interest rate announcement on December 11th. Yeah. So Bank of Canada dropped the interest rates for another 0.5 basis point. So what's your take on that? How is this going to affect people who are actually going to enter the market or looking to renew? And what would be your suggestion?
Yeah, great question. I think the impact on people trying to enter the market is not that significant, simply because the fixed rates are still sitting lower than the variable rates. A lot of times when we think about how something is going to impact, a new home buyer, we think about how it would change their ability to qualify coming into the market. This announcement is not changing the way that they're going to be qualifying. We're just kind of seeing that gap between fixed and variables close, and we're getting closer and closer to coming back to our normalcy, which is the variable rate is supposed to sit below the fixed rate. So we're starting to come back to that. For people who are holding variable rate mortgages, whether you have a 25-year amortization or a 30-year amortization, typically we will see a monthly payment reduction of anywhere from like $15 to $25 for every $100,000 you have borrowed. So I think for people who are, maybe riding that variable wave through the last few years, that probably felt like a little bit of a nightmare. It's providing a little bit of payment relief, which is exciting. As that gap is closing, it's also giving people who are shopping more options. So although today it might not necessarily be increasing their affordability, it's not pigeonholing them the way that I felt like a lot of my clients were pigeonholed over the last couple of years. It was kind of like, okay, just take a fixed rate because that felt like the safest thing for them to do. And now there's a little bit of option. There's a little bit of flavor, which I think is really nice. People can choose if, they want to buy into this concept of stability right now, or if they want the opportunity to kind of ride the market down and see what happens over the next year or so.
No, that's great. Well, these are great insights. And obviously every person has his own situation in terms of the financial aspects. So it's always, the best that, they can consult with a professional mortgage broker so they can actually see what options do they have and what suits them the best.
Yeah.
It's not, one prescription that, can get applied to everyone.
Yeah, absolutely. And I think, just for anyone watching, listening, the biggest takeaway that I think clients and even some real estate agents are having difficulty adjusting to, or maybe just don't quite yet know, is these Bank of Canada announcements are not decreasing fixed rate mortgages. I get that phone call no matter how many times there's been a Bank of Canada announcement. I get phone calls from clients, realtors, everyone. So this is a PSA to everybody that when the prime rate goes down, it is not impacting your fixed rate mortgage. That's priced by a completely different market. It's called the bond market. And the bond market has really already spent the time over the last, I'll say 1-ish years, pricing in to the market what the Bank of Canada is starting to do now. If I look back at a mortgage, I was chatting with a client the other day. I did his mortgage last year and he had a 6.81% on a 3-year fixed mortgage. So we're seeing a lot of those clients kind of coming back into the chat, so to speak, and we're trying to get them lower rates and see what we can do from that for them from just an interest savings standpoint. But I think that's important for people to know.
So would you recommend that people now start to actually think about what they will save actually if they switch to a new mortgage, even though if they're on a fixed rate?
Yes. So if you have a fixed rate mortgage, you're up against a penalty that's called an interest rate differential. And this is a little bit of it's a bit of a tricky penalty, and understanding an interest rate differential penalty it's kind of like an art. A lot of people like to think, if I take out a 5-year mortgage on day one, my penalty's up here, and as I edge towards maturity, it comes down. When in reality, the penalty actually kind of goes like this and like this and like this and like this. The actual terms on a fixed rate mortgage are typically the penalty is the greater of either 3 months interest or an interest rate differential. The interest rate differential is a calculation that's honestly very complex, but I just try to simplify it to clients by saying it's a calculation of cost and time. So if you took a 5-year mortgage and 2 years have passed, you now have 3 years remaining. And a lender's going to ask themselves the question, if I were to take this money back from you at 6%, for example, today, what could I lend it out to a new client for 3 years today?
Of course, going to be for less.
Well, so we think, but there's posted rates and there's all these kind of tricky little fine print things behind the scenes that at some point in that kind of up and down that I described before, the penalty will actually create a negative number. And when it does create that negative number, it makes the 3-month interest penalty the higher of the two. If a client can catch and stay in touch with their mortgage broker or stay in touch with their bank, like just call your bank if you want to break your mortgage and say, hey, if I break my mortgage today, what's the penalty? Sometimes you can catch that 3-month interest penalty, and then it's a significantly lower penalty than it would be if it defaulted to 3 months interest in most, than the interest rate differential in most scenarios. And then now it's just a comparison of, okay, this 3-month interest penalty versus the potential difference that we could get on the interest rate. And for the client in the earlier example, being able to come from maybe a 6.8 to like a 4.2 if they're looking at a fixed rate, or even if, he wants to jump into a variable option, if he comes down to somewhere between 4.5 and 5, that's pretty significant savings to outweigh a potential $5,000 penalty over the next couple of years. So
yeah, exactly. And they can actually tag that into their balance of the mortgage, right?
So in some situations you can, and in some situations you can't. So the person that cannot technically is the person who has an insured mortgage. So think about your buyers who purchase with a less than 20% down payment. This is a very particular type of transaction. It's called an insured switch. And you're basically allowed to pick the mortgage up exactly as it is and move it over to a new lender. They will allow you to cap up to $3,000 of cost or penalty into the new mortgage. When you're increasing a mortgage, it's technically a refinance. So that's why somebody who purchased with a less than 20% down payment, they're not really eligible to refinance because you can only refinance up to 80% of the value of your home. So they might be able to get they will be able to get $3,000 of the penalty added onto the new mortgage, and then they'll have to come up with the rest out of pocket.
Interesting. Well, you mentioned actually something really important about insured mortgages. And as everybody know, as of December 15th, we have this new mortgage rule that came into effect. And it was interesting that it was on a Sunday. So I don't know how is that going to affect, but I'm going to leave it to you. Actually, you have some slides that we're going to put on the screen about the affordability. And, what does that mean for someone who were about to purchase a property for $1.5 million prior to this, and what's going to happen after that.
Yeah.
So tell me, what's your take on that?
So I'm really happy the day has finally come, because what essentially happened here is the government just came out and made an announcement. And while that's exciting to consumers and Canadians, it's very stress-inducing for people who work in the industry, including the banks and lenders. And I was happy to see them actually meet this date. There have been instances in the past where the government has tried to rule something out, and there wasn't enough time for the insurers or for the banking institutions to basically reoperate their businesses in that sector. They have to completely make new policies and procedures, and they have to roll out new products and all of these types of things. So I'm happy that the date is here, and I'm happy that they've met the date. And also, this was announced a couple of months ago, and people have just been peppering everyone in the mortgage space with questions about this, but none of these rules were actually rolled out. You and I were chatting about filming this, and I was like, I have no context to be able to share yet. And I pretty much gained that context like last week on Wednesday. It's exciting. I think that it's basically going to increase like a 30-year amortization, for example, versus a 25. It's basically going to increase somebody's borrowing power by about 5%. So it's not massive, but it's something which is exciting. I think for me, the thing that I'm excited about for a lot of clients is their ability to not necessarily borrow more, but to just improve their cash flow in the household a little bit as they step into home ownership for the first time. I think if we look back over the last couple of years, there's just been so many clients that I've seen who are pulling every single penny together and just trying to make it happen. And it feels like they're just barely doing it.
Just to get that 20% down payment.
Yeah. Or, they're squeaking in with under 20% down, but it's like they're off by a hair, or they're just in by like a hair. And if there was 1 cent difference on their income, for example, or their credit or whatever it is, they wouldn't qualify to do this. So I think it's going to provide a little bit of breathing room for people who are shopping at the top of their budgets. You can definitely speak more to what's specifically been going on with prices and inventory and those types of things. But I think there's been a cooling, obviously, in prices and action out there in the market. I think that consumers should really think about not necessarily using this as an opportunity to maximize, but just to maybe give themselves a little bit more breathing room, because we saw people maximize during the COVID market, and those are the people who are losing their shirts.
We know, what happened. You actually brought a very important, point, because as the affordability improves, because the interest rates are going low, people may start to actually tap into their limits. So this may allow some people that they did not have the 20% to actually be able to buy a home that they actually really like, because still within that 1 million to 1.5 million, still you'll be able to find some decent homes in Toronto that you can raise your family. But still you need to qualify for that. So for a $1.5 million purchase, give or take, you're probably looking at $300,000 annual income. We have a chart, we will actually put it up here, but still you need to get qualified for it, and obviously the payments are going to be slightly higher. There's going to be the insurance premium for that. But again, it might actually help some people to enter the market.
Yeah, I agree. I think, well, maybe just for everybody kind of watching and listening, we can kind of go through what some of these changes are. So as of now, you can purchase up to, or I should say under $1.5 million.
1,499.
Yeah, correct. With a less than 20% down payment. How the down payment tiered system changes is it used to be 5% on the first 500,000 and then 10% on the next 499,999. They've really just extended that 10%, which is something I was very curious about when I saw these changes originally announced. I thought, are they going to make a third tier where it's 15% on $1 million to 14999, whatever? But they actually kept that the same, which is really exciting. First-time home buyers and the ability to have a 30-year amortization. I think that's something that's exciting, and that's kind of what I was alluding to at the beginning of this part of the conversation. So instead of taking a 25-year amortization, you can now stretch that amortization to 30 years. And you can do that if you are a first-time home buyer. And there just needs to be one first-time home buyer on the application, which I think is really cool, because we do see that a lot. We see, younger couples coming together. Maybe one of them already owned a property and now they're going to buy one together. So it's nice that they'll be just applying that as long as we have a first-time buyer on the application. I think people are going to use that strategically. Very exciting, yeah, I think there's a lot of people who are going to use that particular point.
If it's going to help people to enter and be able to find a home that they really like, I think I took it.
I think so too. I think we're going to see a lot of parents actually use their children to fall into that bucket. And it has to be an owner-occupied home, or I'll call it a secondary residence. So it's being occupied potentially by a close family member. It can't be for the purpose of rental. I actually asked one of the insurers today for clarity on one of their sub points to what is defining a first-time home buyer.
Right.
Because for those of you who don't know, a first-time home buyer is defined as someone who has not owned or occupied a property that has been owned by a common law partner or spouse in the last 4 years. There's one little sub tidbit when I was reading some of the insurers' manuals on this, which is they will also actually allow this for people who are recently separated or leaving a marriage. And follow up with me on this in the future. But my particular question was, what does the word recent mean? Because that's a very broad statement.
How recent? 1 month?
Exactly.
2 months? 2 years?
And then what is the threshold of entry from a document perspective? And I think depending on what the answer to this question is, I think that we're going to see a lot of people trying to utilize this loophole as well. I've met many clients just based on like daycare subsidies. They will actually just separate their spouse. They're not actually separating their spouse, but because life in Canada has become a little bit unaffordable for just everyday Canadians, people are going to those drastic measures to try to just kind of get every dollar that they can. So
exactly. No, I mean, if it helps someone to, become a homeowner in any shape or form, that be able to, live in a house that is safe, it's, warm, they can raise a family, why not?
Yeah.
If there's a way to do it, again, that's the importance of talking to a professional. Not making assumptions, not relying just on the news or all the doom and gloom stuff that we see every day. So talk to a mortgage professional, talk to an accountant, and be able to see what your options are.
Yeah,
Perfect.
absolutely.
No, that's awesome.
Yeah.
So next thing I want to talk to you about was if I'm out there shopping for mortgages, fixed or variable. That's $1 million question.
So I have this conversation obviously every day, so many times every single day. And there's two things that I encourage clients to think about because obviously nobody has a crystal ball. The first is, what is the most interest efficient decision? Or what is the decision that we believe is the most interest efficient decision? And I think that this is very closely tied to somebody's risk tolerance as well, and whether they're that doom or gloom, whatever type of viewpoint on things. There's been a lot going on in Canada, in the US politically, around the world politically. All of these things impact the global economy and have the ability to influence the way that we may see interest rates change, as well as what's happening here in our own country. I'm not an economist, and there's definitely way smarter people than myself out there in regards to all the nitty gritty details of this. I just did my own mortgage, and I personally took a variable rate mortgage. And the reason that I did that is I do believe that the Bank of Canada probably has another half, if we're lucky, 1% reduction in them based on just some different economists I've had the ability to speak to. They're looking to see that overnight target rate around 2.5%. I think it's at about
maybe
3.5.
12 months.
Yeah. So if that is the case, what you're really looking at is potentially a variable rate that sits somewhere around 3.4 to 3.7, depending on what the discount you can get off prime is. The second piece that I always tell people to think about is, what is the decision if we're weighing, okay, interest efficiency, what is the decision that makes you sleep at night and not fight with your wife?
Love it. I love that.
Because that answer is different for everyone. And home buying is honestly something that I do a lot with two people. Like there's typically two people involved, three people sometimes, and finances are very stressful. I feel like the state of the Canadian economy recently over the last couple of years is stressful. Every news channel you turn on, everything, it has that doom and gloom kind of thing going on. So what is the decision where you and your partner or whoever you're buying with can make this decision together and feel confident in the decision that you made? Finances definitely cause people to argue. It's one of the largest contributors to divorce. And a lot of people as mortgage brokers and real estate professionals might not think that that's their job to kind of go into that area of the conversation, but I will always go into that area of the conversation. This is the largest financial decision that almost every single Canadian will ever make. And I want them to make it from all angles, not just the one that is the financial angle. So,
and even, for myself as a real estate professional, trying to help and consult people, I always also try to play the devil's advocate. So I always try to tell them, make sure if this happens, you're okay with it.
Yeah.
Because all these scenarios can play out. I just need you to be aware of it. So none of them will come as a surprise. See what works for you best and see what you can afford. And like you said, you'll be able to go to sleep and not, lose sleep at night. That's the best decision for you.
Exactly. And there's so many other things that come into this discussion. Like it's not as simple as being like fixed versus variable under those two umbrellas. What about all of the other little features that come along with these two types of mortgages? And do they match what your short-term and your long-term real estate goals are? If somebody thinks that they're going to sell, do they want the opportunity to get a new mortgage? Do they want the opportunity to port their existing mortgage? A lot of variable rates are not portable. Fixed rates are portable in most situations, which is exciting. Obviously, on average, we see fixed rate penalties significantly larger. If you are going to sell, is the mortgage size that you have large enough to port? Like, is it going to sustain you? Have you thought about the way that you've set up your amortization and everything like that? So it's definitely not a one size fits all, as you say. And we just try to figure out the best way to get them as much of what they want as they can.
Everyone, depending on their situation, could be in a different, environment in terms of the family, what their goals are in the next 3-5 years. And that actually dictates what option suits them the best.
Exactly.
Perfect. So last question. What are the do's and don'ts for people who are actually going to start their pre-approval process? So say I'm in the market, I'm about to start my pre-approval process. What are the things that I should know or should do or should not do that I have a very seamless process and to minimize the stress of going through the pre-approval?
That's a great question. I have so many answers to this question. The first one is check out your financing before you do anything. If there's a thought at all of you purchasing today or in the next 12 months, 24 months, it's never too early to have a conversation. I have conversations with buyers all the time because they think, hey, I want to purchase in 2 years. They're so surprised oftentimes at the number of things that they need to change. And they are so grateful that they had that conversation ahead of time so that they have their to-do list and they know exactly what financial targets, credit targets, saving targets, whatever it is that they need to work towards. And other times people are so surprised. They're like, oh my God, I can actually do this today right now. I thought I was going to need like $100,000 more. So I think doing that first before you're falling in love with the property or wasting your realtor's time. Don't waste your realtor's time. I think that's really important. And then your understanding of what a pre-approval looks like, because this looks very different than what it looked like a couple of years ago, let alone 15, 20, 30 years ago, especially if you have, a loud parent in your ear telling you how this is supposed to go. Like the market is completely different. And what I mean by that is getting a pre-approval and getting to the point that you've actually secured a property and secured a mortgage is such a collaborative process. A lot of lenders are putting in practices that are making pre-approvals a little bit obsolete. And what I mean by that is most lenders will actually not negotiate their lowest rate on a pre-approval. They will not lock it in. Sometimes you'll find a lender that may do it, but oftentimes they won't. They'll actually give you an inflated rate. And the reason that they're doing that is a few things. Number one, they don't necessarily want to commit to funds at a certain cost when there is political uncertainty. And, as much as interest rates are going down, sometimes they're also going up. And like we've seen fixed rates over the last couple of weeks rise. And then from a cost perspective, a lot of people will be like, oh, it's my bank. I've banked with them for 40 years. I'm sorry to break the news, but they don't care. And we're in a really, really capitalistic society here in North America. And when you get a pre-approval, you're effectively wasting basically 8 man hours and $1,000 to a bank. And then maybe when the deal goes live, you walk across the street and you give the actual business that has profit tied to it to, the big red bank across the street. And lenders have recognized that. And they're really just trying to deter people from wanting to get pre-approvals. So having a mortgage professional or a banker, whatever it is for you that you trust, that will be with you guys along the way, I think is really important. You want your income documents underwritten. Sometimes clients will say, hey, just like tell me, like ballpark me so that I can, and I'm like, no. What you think your income is and what myself and a lender thinks your income is are two totally different things. And documents make or break mortgages. You should never want to start shopping without presenting that documentation. And it doesn't tie you to anything. It just makes you 100% confident in where you're at. And then shop, keep your, mortgage broker on speed dial. I think realtors and mortgage brokers should be, grouped together on every single transaction. They just go so much smoother. And then as you're actually getting to that phase where you're putting in an offer, you could be in a completely different interest rate market than you were when you got that pre-approval done. So just having that financial professional on speed dial and understanding it's a collaborative process, I think is really, really important.
No, that's great. And that's why, you always need to chat with the industry professionals, your accountant, mortgage broker, your real estate advisors. So that way you are fully educated so you can make a high quality decision.
Agree.
Not something out of emotions, because I've seen it enough that when people make emotional decisions, especially buying a home, it can go sideways really quick.
Yeah, absolutely. And this is going to sound so biased coming from me, but all banks and lenders are not made equal. So I think having that opportunity to go speak to other professionals is really important, because one lender may give you your dream budget and one lender may give you a budget that falls short of that based on their policies. So most of the time clients chat with their realtors first. You guys are like the pretty faces of the business and we're like the keyboard warriors behind the scene.
But you got the check.
Exactly. So chat with the person that you trust to guide you through this process and say, hey, I spoke to this person and this person. And a lot of times realtors will say, hey, I know you went to your bank, but go speak to my mortgage broker and just get a second opinion.
Because remember, banks only have one product to offer you. Mm-hmm. But the mortgage broker will be able to actually go out and shop the best option for people. So exactly. That's what I always recommend, mortgage brokers over bank. If you want to talk to your bank, sure. at least get an idea of what they're offering, and then be able to talk to a mortgage professional so that they can actually give you all the other options.
Yeah.
Perfect. Well, thank you, Michelle, for your time.
Thank you.
It's been a pleasure.
Yeah.
Yeah, and we will have more of these actually coming up as the rules change, as we see how the market is actually changing, and what the actual experience is on the ground level with these new mortgage rules. And that way we can, put out more educational, material so people can watch, learn, and hopefully make a high quality decision.
Absolutely.
Yeah. Thank you.
Thank you.